Hello and welcome to your Global Markets Technical Outlook as we approach the end of quarter two of 2024. Normal disclaimers apply, of course, and with a quote this time we take from Charlie Munger, who left us recently at the ripe old age of 99, who says that, "Show me the incentive and I will show you the outcome." Not particularly related to the markets as we speak, but just think it's a great quote and explains just about everything from how politicians act to, how you make trading decisions to, that dumb decision that your friend just made. It's all about incentives, folks. And let's just dig straight away into the US stock market. And as we can see here from the monthly chart of the S&P 500, we are back at all-time highs. Surprise, surprise. And we can see that we're basically right in the middle of the range of this long-term channel that we're in all the way back from 2009. This is on a log scale, of course. We did break through that the old high there, and we're now once again in all-time highs, which is, you have to say, very bullish for this market. On the weekly chart, we can see there this just a hint of perhaps a cup and handle there, which is a bullish inverse pattern, and broke through the old high, and then through that 5,000 level, came back just to retest the 5,000 level, obviously the psychologically important 5,000 level, and off it is again, and we're up above 5,400 now. On the Ichimoku chart, no prizes for guessing that we're in a very bullish pattern here. We're well above the cloud, both the price and the Chiku span, both well above the cloud, and the cloud support way back there at 4,400 to 4,600. So quite a way to fall before we re-engage with the cloud there. Sticking over to the market internals now, and on the market breadth, the bullish percent index just starting to wane a little bit there. I mean, I don't think this is anything to be super concerned about at this stage, but just a sign maybe that the momentum, or certainly the participation rate of the stocks is just starting to ease off a little bit. We were making these peaks up around that close to 80 level. Now we're printing 58% of stocks bullish, and we're sitting at all-time highs. So that's not a great participation rate. Obviously speaks to these large growth stocks that's been pulling the market up, doing most of the heavy lifting. But that's just something to keep your eye on. These divergences can go on for months and even years at a time. So we're only really just at the initial stages of this one, is my sense. Looking at another breadth indicator, the stocks above their 200-day moving average, and you can see this one is actually doing not too badly. There's no real sign of divergence here, maybe just a hint of a type B divergence, but you can see that it's certainly in line with previous peaks that we've seen, and currently sitting at around 65% of stocks above their 200-day moving average, which is a reasonably healthy number. The discretionary versus staple also just starting to show a little bit of divergence here. Again, probably not a reason to sell right at the minute, but just something you want to keep your eye on. The discretionary versus staples is obviously often a leading indicator of what the broader market will do. So perhaps this just speaks to us, maybe moving towards a period of consolidation, or maybe even a pullback. I mean, the market is super extended. It's been going up at a rate of knots for a very long time. So it wouldn't be a surprise if it did take a pause, and this is perhaps just something that we're seeing looking towards that. However, if you look at the semiconductors versus the S&P 500, well, this is still rocketing up, and that's probably no surprise in itself, given that the growth, most of the growth stocks are heavily invested in AI. This is basically an AI theme, if you like, that's been driving the market up, and those AI models are very hungry for what's called compute, and that compute takes the form of chip hardware. So the semiconductor manufacturers cannot make these things fast enough to get them out the door. Even second-hand ones are going for 3 times what they were made for, what they originally cost. So this is this is really just another reason to be bullish about this market. While the semiconductors are still being pulled up, then it's a reason to believe that this market should continue, at least in the short term. On the advanced decline line, we can see that this has broken back to all-time highs. We can see that sort of rounded bottom there that sort of reflects what was going on in the market through that 2022-2023 period. It's now popped back up above the old high, and it's back at all-time highs, reflecting what we're seeing in the market. So no divergence there again. And so the weight of evidence is on a continuation. We're probably just seeing the first initial signs that momentum is just perhaps going to start to slow. And if we look at the relative performance of the indexes, this is another reason why we may want to, consider what's going to happen down the track. We're seeing the Nasdaq and the S&P 500. Of course, they're largely influenced by these large growth stroke AI stocks, which have been pulling the market up. Nasdaq sitting at over 15% and S&P up above 13% for the year. However, the Russell, which is the small caps, the small incubator stocks, if you like, that will become the future growth stocks, they're just kind of waning a bit now. So there's more money being funneled into these growth stocks and less money being funneled into the more speculative sector of the market. And again, the small caps will tend to lead the market. So again, just seeing perhaps a little bit divergence here sneaking in. Onto the yield curve, and we can see here that we have a steep inversion on the yield curve still. And that's got a lot of people perplexed. We certainly still have rates very steep here on the short end of the curve. Out in the long end of the curve, it's barely moved. Inflation obviously still a bit sticky. The central bank, the Fed in this case, still keeping rates held a little bit higher. That's causing this inversion. Normally an inversion precedes a recession, but we're not seeing much in the way of recession risks elsewhere in the economy. So this is a little bit of a head scratcher just at the moment. And of course, this is feeding into what's called the probability of recession. This is the New York Fed. They have a model, and that's basically currently sitting at a coin toss right on the 50% line. So whether we get a recession in the next 12 months or not is more or less a coin flip at this stage. On the sentiment indicators, and we're bang in the middle of the range again. This goes back to us it's definitely not a sell signal that we're seeing the start of some divergences in there. And again, this is not indicating that we should be bearish. When the put call ratio nudges down into this what's called this bullish extreme, that's usually the time when we would see an inflection from the upside to the downside. We're clearly not there yet. We're still in the middle of the range, and so there's no extreme bullishness or bearishness in the market as we speak, despite the fact that we're sitting up there at all-time highs. And the VIX is kind of saying the same thing, really, which is the volatility in this market is extremely low, the lowest it's really been, other than this year going back as far as this chart goes. So certainly in the last 2 or 3 years, we're back down around about that 12 area. That indicates a very low risk in the market, indicates nobody's hedging the downside very much. And that's causing the price of the VIX to fall. So, of course, the VIX is a mean reverting index. It's always worth bearing that in mind. So when it gets to these extreme lows, it will tend to bounce up. But we should also say that it can stay at these very low levels for extended periods of time. It doesn't bounce up and down a lot, and it can be very sticky in places. But having said that, it's unlikely to fall much below 12 or so. I think 10 is probably about the lowest we've seen in a very long time. I thought this chart was interesting. This is CNN have what's called a fear and greed index, which takes a look at a lot of different measurements, including market breadth, the momentum and sentiment indicators and so on. They have their current fear and greed index sitting at around 47, which is again bang in the middle. And again, that's just another piece of evidence, if you like, that to feed into your decision-making process. It's certainly not screaming sell at the moment. Nor is it screaming buy, to be fair. But certainly, if you're invested in the market or you're a holder of the market, then this is an indication that there's no reason to change your position just right at the minute. Another indicator which is indicating more or less the same thing, which is the Bank of America's sell-side indicator. So this looks at the allocation in balance funds of equities. So at the moment we're sitting around about 55%, and generally when you see the allocations moving up above this red line, that would tend to signal that the funds are very bullish, and that, you know, that's all that herding into the bullish side will tend to be bearish for the stocks and indicating a reversal. We're certainly not there yet, although we are moving up towards that red line. But you know, you can Google sell side indicator and you'll be able to keep an eye on this one. So keep an eye for it moving up above that red line. But once again, very neutral in terms of sentiment in the market, despite the fact that we're at all-time highs. There doesn't seem to be any irrational exuberance, as one might say. Onto the seasonality, and if we compare the actual S&P down the bottom here to what the seasonality indicator is for the year, it's not a great match, to be honest. Usually January and February are pretty quiet. We had a roaring January and February start of the year as the market took off. A pullback in April is not unusual, and we've certainly had that. And we've moved up since then. We certainly didn't see that sell in May and go away effect just yet. Maybe that's coming, but at the moment it's still rocketing up. So it's not a perfect facsimile to the seasonality, but we'll have to keep an eye on that as time moves on. This is an interesting chart, though, which shows the average monthly gains, June being one of the quietest months. But have a look at this. The next month, July, is the best performing month in the year. Who would have thought? That certainly wouldn't have been my guess, but the stats don't lie, as they say. So you know, we've obviously come a long way just in this year alone, so it would be a big surprise to see such a massive July if we did get that. But there we have it. We'll see how that plays out. We are, of course, in a US presidential election year, so keeping an eye on the presidential cycle. And with this green line here, as we've got the current president is standing again for re-election, so we should in theory be following this green line here. Again, we've had this pullback here in April, and the pullback on the green line is a bit earlier, back here in March, so it could be that we're just running a bit behind the cycle itself. But the green line obviously showing quite a bullish pattern all the way up through the election as well. So again, that's interesting, and that does, you know, if we say that this pullback here was a bit late, then we could be actually following this cycle on this occasion, because it looks very similar otherwise. Year 4 on the decade cycle is generally a quiet year, as you can see here, very sideways with a move up towards the end of the year. Definitely not seeing that this time around. So this decade cycle seems out of whack for this period. On Calvert's decade pressure cycle chart, again, it's showing year 4 being quite quiet. We haven't seen that this time. We've had a massive move up, very big rate of change. So again, we're probably just about out of whack with these decade cycles at the moment. Switching now to the Australian stock market, and on the monthly chart we can see we are actually sitting at all-time, well, very close to all-time highs. We've certainly broken through that old 7600 level, and we are holding above that level. So that is bullish for this market, and I think I did say in the last one, if we can get above 7600 and hold there for a couple of months, that would be bullish. We're certainly doing that, and every time we've retouched the 7600 level, it's found demand. So I think if the market can just consolidate and catch its breath here, then we should probably favor the upside as the next move for the XJO. Zooming into the weekly, you can see that just a little bit more. We've been stuck inside these tram lines here for quite a while, 2 or 3 years, as you can see, going back to 2021. We had that move up there through the late part of last year, and we've just managed to hold now above that 7600 level for quite a few weeks now. So this would be, yeah, short-term bullish for the XJO. And of course, with such a bullish market, you would expect that we are bullish on the Ichimoku, and that we are, with the cloud support down about 7200 to 7300. However, it has been a reasonably quiet year when we compare the XJO to the other US and Asian markets. Here you can see that the Nikkei leading the charge above 16%. Then the S&P, as we know, is above 13. Then we've got the Nifty, the Indian Nifty, coming in next around about 7. The Hang Seng down about 5. And then the XJO bringing up the rear this time at only under 2% up for the year. So the weakest of the bunch. On to the currencies, and on the US dollar index, this 103 level remains the level to keep an eye on. We did see the index pull back to that level there through 2022 and the early part of 2023, and it really just found support around that level. It hasn't really managed to dip down. It touched 100 just briefly, but it's now back above that 103. So we'll obviously have to wait to see what the interest rate picture looks like towards the end of this year, because that will more than likely dictate the next direction of the US dollar index. And that sideways pattern that we're seeing on the US dollar index is really just having an effect on everywhere else. We're seeing the the Aussie dollar here just going sideways round about this sort of, let's call it 63 to 69 level. It doesn't look that far back, but that's almost 18 months ago when the Aussie dollar was last above 70 US cents. So we're just wibbling and wobbling around in this area here as the market consolidates. Probably more than likely going to be dictated, the direction is going to be dictated by the interest rate movements, both in what the RBA does versus what the Federal Reserve do. The euro pretty much in the same boat, just stuck here between that 105 and $1.10 level. On a longer term basis, we're kind of stuck below this descending triangle trend line. As long as it can remain above that 105 level, then the upside probably looks more likely than the downside, but nothing to write home about for the euro for now. And on the Japanese yen, well, the yen remains down, and I think I said last time that this 0.0062 level would be the next level that would come into play, and we're certainly seeing that, despite the Japanese central bank increasing their rates very, very slightly. It wasn't really enough to stop the momentum of this downtrend that's been hammering down with that interest rate differential with the US. But it's interesting to note this 0.0062 level has not been reached since, has not been seen, I should say, since way back here in 1990. So that is a 34-year gap between touches of that horizontal level. So if it manages to break through that level, then we are almost into uncharted territory. And on the Bitcoin, on the weekly chart here, well, we are back around those all-time highs. Who would have thunk it that, you know, back here at the end of 2022, everybody was saying it's the end of crypto. The crypto winter was upon us, and yet bam, bam, bam. Thank you, ma'am. 18 months later, we're back above almost at the 70,000 US dollar mark again. So that's a 350% increase in around about 18 months. So not bad going for Bitcoin. And you would have to say that a breakout to the upside certainly seems far more likely. I'm seeing people talking about 100K by the end of this year. I'll let you make your own mind up. And rounding off on the commodities, crude oil, we're seeing the price kind of just meandering sideways here between that sort of 90-ish level and this high 60s level. Depending where you draw this downtrend or this descending triangle line in, you could make an argument that we've had a breakout above that, but it's, you know, it's hard to call it anything other than sideways as it just drifts along to the right. If it can find some support on this trend line, which it looks like it is trying to do, then perhaps we see a move back in towards 90, and this the next test would be this level up here around about 95 or 96. And on wheat, we're seeing that continue to fall. Certainly, we're seeing some bumper crops around the world, and the supply chain issues are dissipating since the start of the Ukraine war. So that's good news for inflation as well as the price of wheat comes down. And you know, who knows? Maybe we'll see another retest of this 427 level in the next few months or so. That would be interesting to see. Iron ore, again, very, very sideways, and you see back here the start of this year, in fact, it did try to make a move above that 130 level, managed to hold up there for a few weeks, 8 or 9 weeks or so, and then was sold off hard. You know, China's economy is slowing, demand for iron ore is slowing also, and that's having a negative impact. You know, there is just a hint of a trend or of a support line round about there at the $100 level, but if that does not hold, then I think we'd be looking back to that 80 US dollar level. But we'll round off on the two big stories of the commodities, and that, of course, is copper, which had this massive breakout just in the last few months since we last had one of these, in fact. So we were keeping our eye on this symmetrical triangle formation that had been building up for a couple of years, and bam, we certainly got the break to the upside. The breakout above this old 2011 high and above the all-time high as well at $5 a pound there. So that's a great move for copper. It's got quite a long tail on that monthly candle there from last month, so perhaps a sign that it was just a little bit overextended. But if it can spend some time consolidating at these higher levels, then we might expect that there's more to be had on the upside for copper. And lastly, on gold, again, it's another one that had a big punchy breakout since we last spoke. And it's now sitting up here at this 2,300 level after being hemmed in below that 2087 level. It's now reached escape velocity, and it's up, up, up for gold. So very bullish for gold at the moment. So just to summarize that, US stocks are very bullish at all-time highs. I don't think there's anything other to say than it's a very, very bullish outlook for the certainly for the S&P 500 and the Nasdaq. We are just seeing a couple of those market internals starting to slow down a little bit, so that's just something to keep an eye on for now. On the Aussie 200, well, we're in the breakout. We're in those heady reaches above 7,600, and if we can hold up there, I think there's probably further upside to be had on the Aussie 200. On the currencies, a lot of them going sideways because that's what the US dollar is doing, although we're still seeing the yen falling hard, and Bitcoin doing the opposite. That's rocketed back to its all-time highs once again. And on the commodities, well, copper and gold are showing those breakouts, and we are seeing just a little bit of weakness elsewhere. Just before I let you go, I thought I'd just check in with a couple of the strategies that I'm trading at the moment. SmartSystematicTrading.com, where you'll get the the latest information on these. Monterey's and NASDAQ stocks, rotational strategy. Obviously, NASDAQ's been doing very well this year. This has been doing even better, up 34% for this year. So not unhappy with the progress on that one. Dolphin itself, which is a mean revert ETF, obviously does better when the markets are more volatile. They've been very quiet, as we saw from the VIX chart earlier. So not up a whole lot for this year, but the 90% win rate's still holding up. And I tend to trade them both. If you put 50-50 allocation, you end up with around about 19% on average, and a sharp above 1.2. So check out those, smartsystematictrading.com, and let me know if you have any questions on those. So I'll thank you very much for your attention. Wish you good trading. All the best for the next quarter. Thank you very much, and bye for now.